Hello, everyone. In this presentation, we'll be discussing key aspects of JP Morgan Chase commercial banking line and some important key risk indicators that can be used to assess its current performance. JP Morgan Chase commercial line banking division provides a wide range of financial solutions tailored for businesses, corporations, and institutional clients. Some of the core services they offer include lending and credit solutions, payment processing, liquidity management, which helps businesses manage each cash flow efficiently. They're also active in commercial real estate banking, supporting clients with financing for property development and investments. On a global scale, JP Morgan offers international services such as cross-border payment processing, allowing clients to conduct business around the world smoothly. Overall, this line of business plays a crucial role in supporting financial needs of mid-sized and large organizations. The first key risk indicator that I'll be highlighting here is the loan to deposit ratio. This ratio is calculated by taking the total value of loans, dividing it by the total value of deposits, and multiplying it by 100. Ideally, JP Morgan Chase should be aimed for a loan to deposit ratio between 70 and 90%. When the ratio is below 70%, it suggests that the bank is not lending enough, which can lead to missed earning opportunities. They may need to encourage more lending. While on the other hand, when the ratio is above 90, the bank may be taking on higher risk than it needs to, because it has fewer deposits available to cover unexpected liquidity needs. In that case, the focus should be shifted from deposits to managing loan levels. As noted by Cesar in 2025, a high loan to deposit ratio signals aggressive lending and possible liquidity shortages, while a low loan to deposit ratio indicates underuse of resources and reduced profitability. In summary, the loan to deposit ratio is a valuable key risk indicator because it provides insight into liquidity health and the stability of the bank's funding. The second key risk indicator that I'd like to discuss is the employee turnover rate, which measures how frequently employees leave the organization, whether it's voluntary or involuntary, over a certain period of time. To calculate it, you divide the number of employee departures by the average headcount and multiply it by 100. This key risk indicator is important for identifying operational or cultural risks within the company. For example, if the turnover is unusually high in one particular department, it might signal some internal issues such as poor management, workload imbalance, or low employee morale. So that kind of spike should trigger further review. Research by Singh Wang and their colleagues in 2017 emphasizes that employee turnover is a major challenge for companies seeking long-term growth. Understanding risk factors that contribute to turnover will help lenders and HR teams take corrective actions before the issue becomes more serious. Ultimately, tracking turnover and supports organizational stability and effective workforce planning.
Thank you so much for that, Caesar. One commonly strong key risk indicator is the borrower's credit score at the point of application. A borrower's credit score will show sufficient insight to their past credit history. The score itself is a direct trigger placement when qualifying most any applicant by placing the individual into a category of solutions that best fit that score range directly. A higher score typically reflects a more ideal borrower rather than a lower score, showing increased uncertainty for repaying that debt. Banks and commercial lending understand this instance must be sustainably balanced throughout scenario planning. Offering too many loans for low credit score borrowers can reflect in a great impact for the organization, while that further increases the risk of default on the loan or credit account. Diversifying their lending portfolio prevents catastrophic impacts. By analyzing recurring consumer complaint volume, JP Morgan can understand the trends of where the issue is specifically occurring. For the key risk indicator of consumer complaint volume, these instances can be processing delays or communication issues across or within departments. This serves an important role within scenario planning to predict patterns early and funneling proper escalations or preventing them from growing altogether. Many major companies utilize the key risk indicator of cybersecurity breach attempt success rate, as this can be one of the most capital draining efforts for enhanced protection. This not only presents itself as a measure of early detection, but a warning for the possible need to reinvest if the success rate count is or becomes too high, representing a concerning requirement. Once the KRI is identified through daily operations, a major factor is the ability for JP Morgan to react accordingly, reducing the overall stress of cyber threats. A strong recommendation for the organization is to implement the additional oversight within third-party transactions, really ensuring enhanced protection all around. The final recommendation would be to continuously reinvest into breach testing and protocols and simulations for sustainable security. And thank you.